You didn't just watch a commodity move on a chart this week. You watched a regime blink. You watched the kind of quiet procedural adjustment that only happens when the people running the casino start to feel heat under the floorboards. And if you felt that little tightening in your chest when the screen turned red, good. Because that's your instinct, noticing what your apps will never explain. They want you staring at the number like it's the whole story. They want you hypnotized by the candle, arguing about support at 72, fair value at 70, and whether it's overbought. But tell me something, why does the most important asset in the supply chain for energy, electronics, and national security trade like a toy until it suddenly doesn't? Why does it behave like a normal market, right up until the moment the plumbing starts screaming? Because the number on the screen isn't always a price. Sometimes it's a confession that the bridge between paper and physical is cracking, and the people who used to control the bridge are starting to lose the timetable. We told you this wouldn't end quietly, didn't we? So let's talk like adults who have watched this system lie for decades. In a healthy market, the same metal does not develop two realities with two different prices for long. In a healthy market, if one city bids higher than another, the metal moves, the gap closes, and the only people who get rich are the ones fast enough to bridge it. In a functioning market, you don't need pep talks, you don't need slogans, because the mechanism itself enforces honesty. But what happens when the mechanism stops enforcing honesty? What happens when arbitrage becomes a word you say out loud, but can't actually do because the metal is trapped behind paperwork, taxes, controls, and logistics that act like a hidden wall? What happens when the West keeps printing claims and the East keeps taking delivery, and for the first time in your lifetime, those two behaviors stop agreeing on a single number? That's not a squeeze anymore, that's a takeover in slow motion. You've been told for years that the silver story is simple. Solar panels are growing, demand is rising, therefore silver should rise. End of story. That's the kind of explanation they feed people who are supposed to stay asleep. The real story isn't solar demand, it's who owns the factory floor, who owns the supply chain, who gets to decide where strategic inputs flow, and who gets stuck paying whatever the new rules demand. Here's the first brutal fact that changes the whole frame. The International Energy Agency has laid it out plainly. China dominates the manufacturing chain for solar, not by a little, but by levels that break the idea of a diversified global market. We're talking about control across the key stages that sits above 80% in crucial segments. 80% is not competitive advantage. 80% is you live under my weather now. And now ask yourself the question they don't want you asking. If a country controls the factories that turn sunlight into electricity, what else does it control? It controls the tempo of deployment, the pricing power, the export leverage, the strategic dependency of everyone who decided to outsource their industrial base. And when that country needs silver as an input, it doesn't need to scream about it on television. It doesn't need to publish a manifesto. They just need to make sure the material stays where the factories are. This is where the story gets uncomfortable, because it stops being about investing and starts being about sovereignty. A solar cell uses silver in the contacts, in the paste, in the fine lines that carry electrons like tiny highways. You can reduce usage over time, you can thrift it, you can innovate around it, and yes, those trends are real and they matter. But you can't wish the need away on command, not when the world is trying to electrify everything at once while pretending energy is a moral narrative instead of a supply chain reality. So when you hear that China tightened how silver gets exported, don't think of it as a headline. Think of it as a lever being quietly pulled. Reuters reported that China published a list of companies permitted to export silver for the coming period, which tells you in plain language that the flow is not free market. It's administered. They don't need to ban the metal outright to change the outcome. They just need to turn export into a permission system, and suddenly the West learns what it feels like when an input becomes strategic. Now, the loudest people will take that and run into fantasy. They'll tell you it's a total blockade, that nothing leaves, that it's a secret operation, that someone in a back room confirmed it. I'm not interested in bedtime stories. I'm interested in what can be verified and what it implies, because that's how you stay alive in markets that punish imagination and reward clarity. A licensing regime is enough because it introduces friction, delay, and discretion, and those three things are poison to anyone relying on just-in-time global supply. And here is where we get to the signal that makes grown adults nervous: the spread, the premium, the gap that won't behave like a normal gap. Because on paper, if Shanghai bids meaningfully above New York, you should be looking at free money, right? Buy the cheap metal in one place, sell it in the other, pocket the difference, watch the gap disappear like a magic trick. So why doesn't it disappear? Why would a gap persist if the world is supposedly one connected, efficient market? Why would the same metal wear two different price tags long enough for you to talk about it in a video? What do you think has to be true for that to happen? Either the barriers are bigger than the traders, or the paper price is doing a job that the physical price refuses to do. Now, let me be careful here, because this is where people get sloppy. A Shanghai premium is not automatically proof that New York has no silver. Markets can split for reasons that have nothing to do with empty vaults, and everything to do with taxes, delivery rules, capital controls, product specifications, and the ugly reality that moving metal is not like moving a JPEG. But here is the part you cannot wave away. Even if you account for friction, even if you allow for tax and structure, the persistence of tension is a symptom. It tells you demand is not theoretical, it's real. It tells you industrial buyers aren't negotiating with the narrative, they're paying to secure flow. And when that behavior becomes persistent, the paper market has a problem, because paper can't fabricate time, and it can't fabricate shipping lanes, and it can't fabricate trust. And trust is the real commodity here. In a world that trusts the system, the futures price is accepted as a credible promise. In a world that stops trusting the system, the futures price becomes a negotiable suggestion. That's when you start seeing physical premiums, delivery delays, and special rules, and everyone pretends it's normal because admitting the truth would collapse confidence. We told you this is how it happens. First the market looks weird, then the rules get adjusted, then the television tells you nothing is wrong. Now let's talk about the move that was the real warning shot, the margin hike. Not because margin is exciting, not because it's dramatic, but because it was a lever. The system pulls when it wants to change behavior without admitting it as doing so. People hear margin requirement updated, and they yawn, because the language is designed to make you yawn. But the effect is not boring if you're the one holding the contract. The CME raised the initial margin requirement for a standard 5,000-ounce silver futures contract to about $25,000, up from about $22,000, with maintenance rising alongside it. That is not a rumor, it's a published clearing notice. And anyone who has lived through these markets knows exactly what that means in practice. It doesn't matter whether you were right on direction. It matters whether you can survive the rules changing mid-game. Think about the structure for a second. A futures contract represents 5,000 ounces. If silver is around $72 per ounce, that contract represents around $360,000 of metal. And you don't post $360,000. You post a fraction, a performance bond, a deposit that gives you leverage, and leverage is where the whole machine becomes fragile. So what happens when the exchange raises the cost of holding the same exposure overnight? What happens to the trader who built a position with tight cash buffers, who thought the rules were stable, who is now suddenly under margin because the price of admission changed? They get a margin call. And a margin call doesn't care about your thesis, it doesn't care about your conviction, it doesn't care about your morality. It cares about collateral, and collateral is the religion of this system. If you're fully invested, you don't have spare cash sitting around. You have positions, you have assets already committed. So what do you do when they say, wire more by morning? You sell something, you liquidate, you reduce. And if enough people are forced to liquidate at the same time, the selling pressure becomes self-fulfilling, and the chart prints the exact fear that justifies the narrative they want to push. Now, the exchange will tell you margin hikes are about risk management, about protecting the integrity of the market. Sometimes that's true. Sometimes volatility demands more cushion. But let me ask you a question that cuts through the fog. If the market is stable and healthy, why does it need these sudden procedural shocks to keep it safe? And why do these shocks so often land at moments that hurt one side of the trade more than the other? Here's what I watch, because I've seen this movie too many times. I watch whether the rules change when the public starts paying attention. I watch whether the rule changes coincide with an obvious narrative push from the same institutions that benefit from the outcome. And I watch whether the underlying physical signals improve or deteriorate while the paper mechanisms get tightened. Because that's the pattern. Paper gets tightened when physical gets stressed. Leverage gets punished when delivery becomes uncomfortable. This is not mysticism. This is how a leveraged promise behaves when the world starts asking for the thing promised. And that brings us to the other boring document that matters more than any influencer rant, the Commitment of Traders report. The CFTC data has shown that the commercial category, which includes the big institutional players tied to the physical trade and the hedging complex, can carry enormous net short exposure. For the week ending in late December, the net short position in that category was on the order of tens of thousands of contracts. Multiply tens of thousands by 5,000 ounces, and you are talking about a net paper exposure that maps to hundreds of millions of ounces. Now be precise with your mind here. Net short does not automatically mean evil. Hedging exists. Producers hedge. Merchants hedge. The world uses futures for legitimate purposes. But it does mean something when net short positioning stays large while physical demand signals keep flashing. It means the system is leaning hard on the idea that paper can satisfy the world's need for price discovery without ever forcing uncomfortable delivery realities. And when that lean becomes too aggressive, the system becomes brittle. This is where people like to shout default. They like to say the vaults are empty, the exchange will collapse, cash settlement is inevitable. I'm not going to feed you certainty I can't prove. What I will tell you is simpler and more useful. The moment the market has to start discouraging participation through margin, the moment it has to start managing behavior instead of just clearing trades, that's the moment you should assume stress exists somewhere in the chain. And yes, there are hard numbers on inventory. COMEX publishes warehouse stocks in a registered category that represents metal available for delivery under exchange rules. That registered number is not zero. It has been in the hundreds of millions of ounces at various times, and around early January it sat on the order of 128 million ounces registered. So don't let anyone hypnotize you with there is none, because that's sloppy and it's easy to debunk. But don't let the presence of registered metal lull you either, because the question isn't whether there is any metal at all. The question is, how much is truly available at current terms, at current price, under current incentive, if demand for delivery rises? How much of that registered inventory is stable, and how much is a number that can change as owners reclassify, move, or refuse to make it available? In a stressed system, inventory isn't just a quantity, it's a willingness, and willingness collapses when price is wrong. If you owned metal and you believed the market price was a lie, what would you do? Would you deliver into a system that underpays you? Would you hand strategic inventory to counterparties who treat it like a chip in a casino? Or would you hold, demand premium, and wait for the paper world to come closer to the physical world's reality? That's what a bifurcation is. Not two prices, but two sets of incentives that no longer match. Now add the geopolitical layer, because this is where people miss the real engine. Silver is not just an investment metal. It's a defense metal, an electronics metal, a power metal, a medical metal, a grid metal. And in a world where the supply chain is being weaponized in real time, you don't get to pretend inputs remain apolitical. The moment export regimes tighten, the moment energy shocks threaten inflation again, the moment shipping lanes become bargaining chips, every strategic commodity starts carrying an embedded risk premium. The script you showed me talked about Venezuela, about U.S. enforcement actions at sea, or about intercepting flows. Here's what matters. In recent months, there have been credible reports of U.S. actions tied to sanctions enforcement, including seizures and interdiction-like operations linked to Venezuelan oil shipments. You don't need to call it a full blockade to understand the implication. The implication is that energy flow can be disrupted by policy, and energy markets price disruption, like a disease, spreading risk into everything. Then the script drags Nigeria into it with talk of coordinated strikes across oil fields. I've learned to treat those sweeping claims like a gun on the table. If you can T-verify it, don't build the whole scene around it. Nigeria has had energy infrastructure disruptions and incidents, including pipeline and gas system problems, and those can matter. But you should not need a dramatic, confirmed, coordinated strikes storyline to make the point, because the point is broader. Energy vulnerability is back, and when energy vulnerability returns, inflation expectations stop behaving. Do you remember the 1970s, even if you weren't alive for it? I do, because I've studied it like a crime scene. When energy shocks hit, the cost structure of everything shifts, and central banks get trapped between recession and inflation. They tighten, and they break something, or they ease, and they debase something. Either way, trust erodes. And when trust erodes, the demand for hard, unprintable assets rises, not because people are greedy, but because they are trying to avoid being the last one holding promises. When the promise makers start rewriting the terms, this is what people mean when they talk about a war bid. Not that someone is cheering for war, the opposite. It means markets start pricing the possibility of disruption, the possibility of escalation, the possibility that supply chains and currencies will be used as weapons. And when that possibility enters the bloodstream, paper claims become less attractive because paper is polite only in polite times. Now combine the layers, and you can see why this moment feels different. On one side, you have the West, still treating price discovery like an accounting trick, printing leverage, leaning on derivatives, comforting itself with the belief that the screen is reality. On the other side, you have the East, building factories, building grids, building inventory, and paying up for physical when necessary. And you have a growing sign that the East is willing to tolerate higher prices because it values continuity and sovereignty more than it values the illusion of cheapness. We told you this is the real pivot, paper versus physical, and East versus West. It's not a slogan, it's a description of behavior. The West has become a civilization of claims. Claims on assets, claims on future output, claims on liquidity, claims that everything can be rolled, refinanced, papered over. The East, especially parts of Asia, has acted like a civilization of accumulation, of tangible inputs, of inventory as strategy, not as leftover. And what happens when a civilization of claims meets a civilization of accumulation? It works as long as the civilization of claims is trusted. It works as long as the claim is accepted as good as the thing itself. But when the claim starts being questioned, the whole machine starts making noises you can't unhear. That's why the margin hike matters. It's why export licensing matters. It's why premiums matter. These are not random events. They are the symptoms of a system trying to maintain the appearance of continuity while the underlying incentives are diverging. And when incentives diverge, the system must either reprice, or it must impose controls, or it must find a way to socialize the pain. And who pays when the system socializes the pain? You do. You pay through inflation. You pay through lost purchasing power. You pay when pensions underperform because real assets outrun the paper returns the system promised. And you pay in the most insulting way. They all tell you it's your fault for not understanding risk, while they adjust the rules of the casino to protect the house. Now, the retail crowd hears this and immediately wants a villain with a name. They want a single bank to blame, a single desk to hate. That's emotionally satisfying, but it's not always strategically useful. The deeper villain, if you want to call it that, is the structure, a pricing mechanism that can be dominated by leveraged paper claims while physical demand builds quietly elsewhere, until the gap becomes too wide to ignore. Let's be honest about what the futures market is. It's a brilliant tool and a dangerous weapon. It allows producers and consumers to hedge. It allows speculators to provide liquidity. It allows price discovery. But it also allows leverage, and leverage is always a temptation for institutions that think they can shape outcomes. When you can control $360,000 of metal with $25,000 of collateral, you're not trading the metal, you're trading the confidence in the mechanism. And confidence is a funny thing. It's abundant until it's not. It's like oxygen, invisible until the room starts running out. When confidence is plentiful, the market functions, the spread closes, the margin rules feel stable. When confidence starts draining, you see it in little procedural moves, little narrative pushes, little changes in what is allowed, and the crowd doesn't notice until the system is already halfway through the transition. That's why I keep coming back to the simplest question you should ask in any market, especially now. If the system is healthy, why does it need coercion to keep you in line? If the system is healthy, why does it need the media to mock people who buy the one asset they can T-print? If the system is healthy, why does it need to keep telling you in 1,000 different ways that you're crazy for wanting something tangible? Look at what they do, not what they say. They raise margins. They publish bearish notes. They talk down rallies. They create a mood of fragility. And then they use that mood to harvest liquidity. Because liquidity is the blood they need to escape positions without paying the price their own actions would otherwise create. This is where the exit memo storyline comes in, and I want you to handle it with discipline. It is common for major institutions to publish notes advising clients to reduce exposure after a strong move. That's not inherently sinister, but it becomes interesting when those notes align with procedural pressures, like margin hikes, and when the underlying physical demand signals don't match the bearish tone. Why? Because markets are a two-sided game. For every seller, there must be a buyer. So when the largest institutions are encouraging a wave of selling, you should always ask who benefits from that wave. Who needs that supply? Who needs that liquidity? Who needs you to believe the rally is over so they can quietly accumulate without lighting the chart on fire? Now, I'm not telling you the memo is proof of a conspiracy. I'm telling you it's proof that narrative is a tool. And you should stop treating narrative like entertainment, because in markets, narrative is often a weapon designed to move your behavior. It tells you when to feel safe. It tells you when to feel stupid. It tells you when to sell the thing you'll later struggle to buy back. We warned you about this psychological warfare. We warned you they would try to shake you out with red candles and ridicule. We warned you they would try to make you angry at the wrong target, because anger makes you impulsive. If you're angry, you want to do something. And doing something is usually exactly what the machine wants, because it turns your position into their liquidity. So let's strip the emotion out and keep the power. If the East continues to accumulate physical inputs for energy and industry, and if export regimes add friction, and if energy risk returns, and if commercial net short exposure stays heavy, then the paper market's job gets harder. The paper market can still smash price in the short term because leverage always gives you short-term violence. But the more physical demand becomes insensitive to paper drops, the more every smash becomes a gift to the buyer and a trap to the seller. That's the heart of the takeover thesis, but you need to phrase it correctly. It's not that a country flips a switch and takes over the market overnight. It's that the center of gravity in price discovery shifts when the marginal buyer is no longer a Western speculator trading paper, but an industrial system buying physical for real-world output. And when the marginal buyer changes, the tools that used to work stop working the same way. In the old regime, if the price dropped, the buyers ran away because they were paper hands chasing momentum. In the new regime, if the price drops, the buyers show up because they are factories and procurement desks and strategic stockpiles that measure their world in supply security, not in daily candles. That's why you get the beach ball underwater effect, push it down, and it pops back up because real demand is underneath. Now, before you let that make you reckless, remember the other truth. Paper markets can stay irrational longer than you can stay solvent if you play them with leverage. That's not a slogan. That's a survival rule. That's why the margin hike is the perfect weapon against the undisciplined. It doesn't need to prove you wrong on thesis. It only needs to force you to sell at the wrong time because you can meet the collateral terms. And that's why the cleanest form of agency in a period like this is not bravado. It's structure. It's refusing to be the easiest victim of rule changes. It's refusing to build a position that can be destroyed by a Sunday night paperwork update. I'm not here to tell you to buy or sell. I'm here to remove the element of surprise, because surprise is how systems extract wealth from people who are asleep. So what should you actually watch if you want to know whether this is a real pivot or just another noisy episode? Watch the spread behavior between paper and physical, but understand the frictions so you don't fall for simplistic free money talk. Watch the export regime decisions, not the rumors, because policy is the thing that makes supply chains stiff. Watch the warehouse reports, not as a prophecy, but as a sentiment indicator. When register changes, ask why, ask who is moving metal, ask what incentives would cause it. Watch the commitment of traders over time, not 1 week, because positioning tells you where pressure builds. Watch whether margin and rule adjustments increase during periods that are not obviously chaotic, because that indicates preemptive defense. And watch the media tone, because when the tone becomes coordinated ridicule, it often means the asset is becoming politically inconvenient to own. Now, I want you to think about the most underappreciated part of this entire story. The West grew up believing price is a discovery process. The East has been acting like price is a procurement problem. In discovery, you care about charts and narratives. In procurement, you care about continuity, availability, and control. When procurement dominates, the price becomes whatever clears the physical flow, not whatever clears the leveraged paper. That's why the solar story matters, even if silver thrifting continues. Because even with thrift, scale overwhelms. Even if each panel uses less silver than a decade ago, the world is trying to install so much capacity that the total input burden remains significant. And when one country dominates manufacturing, it doesn't just consume silver, it influences where silver goes, who gets access, and what premium must be paid to secure it. Then add the reality that the West is trying to rebuild industrial capacity while carrying debt burdens that make every policy choice painful. When a government is deep in debt, it has less freedom, not more. It must protect financial stability, and financial stability often means protecting the institutions that hold the collateral. So when stress rises, they protect the balance sheets first and explain it later. Do you see how the puzzle pieces lock? Export friction raises physical tightness. Energy risk raises inflation risk. Inflation risk raises distrust in currency promises. Distrust drives demand for hard assets. Hard asset. Demand pressures, paper positions. Paper positions respond with rule changes and narrative warfare. That cycle is not a conspiracy, it's self-preservation in a system designed to prioritize its own continuity. And this is where I need you to zoom out even further, because this is bigger than silver. Silver is the canary because it sits at the intersection of money and industry. Gold is monetary, yes. Oil is strategic, yes. But silver is the metal that reveals how monetary games collide with physical necessity. When the monetary system gets sloppy and the industrial system gets hungry, silver becomes the seam where the fabric tears. For 50 years, the West has had the privilege of setting global prices through London and New York, through benchmarks and paper. That privilege only exists as long as the world accepts the paper as credible. But when major industrial buyers start paying higher in their own systems, when their demand becomes the floor, the West's ability to dictate value weakens. It doesn't vanish overnight. It erodes, spread by spread. Rule change by rule change, premium by premium. And that erosion is what end-of-era transitions look like. They don't announce themselves with fireworks. They arrive with awkward divergences and procedural stress. The party upstairs keeps going, the music stays loud, the anchors keep smiling, and the fire alarm has been ringing in the basement for hours. Then one day the smoke reaches the ballroom, and everyone suddenly remembers the exits. We told you the era you grew up in is ending. We told you soft landings are marketing slogans, not physics. We told you systems built on leverage and confidence don't unwind politely. They unwind through denial, then through forced selling, then through rules that change when the wrong people start winning. And if you want to understand what comes next, you don't need secret intel, you need pattern recognition. If the spread between paper and physical continues to signal tension, the likely outcome is not that physical collapses to match paper. The likely outcome, unless demand breaks, is that paper eventually has to rise to meet physical, because paper cannot print ounces into existence. Paper can only print time, and time is the one thing a supply chain eventually refuses to sell. If the export licensing regime tightens or becomes more restrictive under stress, physical premiums can become more persistent, not less. If energy risk remains elevated, the war bid in hard assets can remain a floor that makes deep suppression harder. But you should also respect the counterforce, because the counterforce is always there. The counterforce is liquidity shock. The counterforce is forced liquidation. The counterforce is a sudden dollar squeeze where everything gets sold to raise cash. The counterforce is not a moral argument. It's a mechanical argument. And in the short term, mechanics can bully fundamentals, especially in leveraged markets. That's why I keep separating paper behavior from physical reality. A paper flush can happen even in a physically tight world because paper trades collateral, not metal. A paper flush can happen because the exchange raises the cost of holding risk and weak hands get washed out. That doesn't prove the thesis is dead. It proves that the system still knows how to create pain at the precise moment it needs liquidity. So what does agency look like in a world like this? It looks like refusing to confuse volatility with truth. It looks like refusing to build your entire understanding on the last candle. It looks like refusing to outsource your mind to institutions that have conflicts of interest and a history of denial. And it looks like understanding the difference between a claim on something and the thing itself. Because here's the most brutal line in this whole story, and it's the one they'll never say out loud. When stress becomes extreme, promises get renegotiated. Not because the law disappears, but because power asserts itself through clauses, through emergency rules, through extraordinary circumstances. Exchanges have force majeure frameworks. Banks have settlement discretion. Brokers have risk controls. None of that is automatically evil. But all of it exists for one reason: to keep the system functioning when the system would otherwise snap. So ask yourself the simplest question. In a true scarcity event, when the metal becomes strategic, do you think the system is designed to prioritize your claim check or to prioritize its own continuity? Do you think it will deliver real strategic material to every paper claimant at the exact moment governments and industries are competing for the same input? Or do you think, in that moment, the system will find a way to settle the paper in a form that preserves its own stability? I'm not predicting a guaranteed outcome. I'm telling you how institutions behave under stress, because I've watched it. They call it orderly markets. You feel it as the rules changing around you. They call it stability. You live it as higher prices and fewer options. They call it risk management. You see it as the cost of holding a position rising precisely when the thesis becomes inconvenient for someone with size. Now, let's bring this back to the here and now, because this week is a test. It's not the final battle. It's a test of whether the old tools still work against the new buyer. It as a test of whether a margin hike and narrative pressure can still flush the market into the levels the shorts need. It's a test of whether physical demand, procurement demand, and Eastern bid behavior will absorb the dip the way a hungry industrial system absorbs any discount. And you will know the answer not by listening to me, but by watching behavior. If they smash price and it keeps snapping back, that's buoyancy. If they smash price and physical premiums stay firm, that's divergence. If they smash price and the spread widens rather than closes, that's the rubber band stretching. And rubber bands do not stretch forever. In a controlled system, the rubber band is managed, the volatility is kept within the illusion range, and the public stays asleep. In a stressed system, the rubber band keeps getting pulled by forces that no press release can stop. The East pulls for procurement. The West pushes for narrative control. The exchange adjusts rules. The bank's hunt stops. And the chart starts looking like a heart monitor because the system is fighting itself. And yes, the stop-loss hunting story is real in spirit, even if people dramatize it. Order clusters exist. Liquidity pockets exist. Algorithms exploit predictable behavior. When the crowd places stops at obvious levels, the market can and will probe those levels because that's how liquidity gets harvested. The lesson isn't paranoia. The lesson is done to be predictable when you re-trading against machines built to exploit predictability. But again, don't turn this into trade advice. Turn it into mental discipline. Recognize that short-term price action in leveraged markets is not a referendum on truth. Recognize that a paper flush is often engineered pain designed to create sellers, because sellers are the raw material the shorts need to exit. And recognize the ultimate asymmetry. Paper players can be forced out by margin, by brokers, by rules, by volatility, by their own fear. Physical holders cannot be margin called out of an ounce in a private vault. That's why the system mocks physical ownership, because it removes you from their control mechanisms. They can't raise the margin on your safe. They can't force liquidate your coin. They can't cash settle something you already possess. They can change the price on a screen, yes, but they can't change the reality that you own a thing that exists and exists outside their balance sheet. And this is where the empowerment comes in, because you're not helpless. You cannot control what banks do. You cannot control what exchanges do. You cannot control what governments do when debt and politics collide. But you can control whether you sleepwalk. You can control whether you build your understanding on slogans or on mechanisms. You can control whether you live inside the paper narrative or whether you respect physical constraints as the final judge. We warned you that the end of an era would feel like this. It would feel like confusion on the surface and clarity underneath. It would feel like the media insisting nothing is happening while the plumbing changes quietly. It would feel like markets becoming more violent, not because the world is stable, but because stability requires more and more coercion to maintain. So when you see the next red candle, don't ask, is silver dead? Ask, who needed that candle to print? Ask, what rule changed to make that candle possible? Ask, what physical signal stayed firm while the paper signal screamed? Ask, what does it mean that one side of the world keeps paying up while the other side keeps trying to talk it down? Because this isn't ultimately about a number, it's about control. It is about whether the world continues to accept Western paper benchmarks as the authoritative price of strategic inputs, or whether the center of gravity shifts toward the places that build, accumulate, and take delivery. It's about whether the future monetary system remains one where claims can be multiplied without consequence, or one where hard constraints reassert themselves with ugly speed. And if you're waiting for a headline that says, the old system is over, you will miss the transition. The old system doesn't die in public. It dies through exceptions. It dies through special rules. It dies through persistent spreads. It dies through export licensing. It dies through margin hikes that show you, in bureaucratic language, that the game is getting harder to play on paper. They told you this was just a trade. We told you it was a regime change hiding inside a trade. They told you it was a correction. We told you it was stress management. They told you the squeeze was dead. We told you the real fight would begin when the system started changing the rules instead of just changing the price. Now we're here. The microphone is live. The bell is about to ring. And the only thing that matters is whether you interpret what you're seeing as noise or as the sound of a machine slipping a gear it was never supposed to slip. So keep your eyes on the signals that don't care about opinion. Keep your eyes on how export friction evolves, because that tells you where the metal is allowed to flow. Keep your eyes on warehouse categories and delivery interest, because that tells you how comfortable the system is with physical settlement. Keep your eyes on positioning and the cost of leverage, because that tells you how desperate the system is to discourage participation without admitting why. And most of all, keep your eyes on your own psychology. Why do you think they want you exhausted? Why do you think they want you angry? Why do you think they want you to feel stupid for wanting something real? Because a tired, angry person sells at the worst time, and a calm, awake person refuses to donate their position to someone who needs it. This is the end of cycle feeling you can't fake. The sense that the party is over and the hosts are pretending the lights aren't flickering. The sense that the mask is slipping and the people holding it in place are running out of hands. The sense that the era of effortless paper comfort is colliding with the era of physical constraint, and the collision is going to be priced in volatility. If this continues, you're going to see more rule changes dressed up as prudence. You're going to see more narratives dressed up as analysis. You're going to see more sudden flushes designed to harvest liquidity. And you're going to see a growing stubbornness underneath it all, a bid that keeps returning, because the world that makes things does not care about your chart if it can to get the metal. You don't need to worship silver. You don't need to turn it into religion. You need to understand what it represents in this moment, a stress test of the paper order, a stress test of who sets value, a stress test of whether promises still clear the world or whether the world is quietly choosing the thing itself over the claim. And if you can see that, you're already ahead of most people, because most people will keep staring at the candle until the day the candle becomes a door slamming shut. We warned you. We told you this wouldn't end quietly. Now the only question is whether you recognize the sound while there is still time to think clearly.